Hey there, guys. Todd and Kyle Inside Edge. It is August 7th, Thursday, and I, I don't even want to go here, but live stream, we found another issue. Live stream didn't work again, even after testing. We're going to continue to do it, but probably for now, we're going to do pre recorded until we absolutely have the live stream perfected as to save your time. So, uh, anyways, hey, happy Thursday. Hey, Kyle, what's going on? Kyle Wasson, the COO, head of planning, my right hand man, and new father, beautiful baby Alice. What's going on with you?
And not the tech guy, but I need to be helping with that way more. I'm good. We're doing good. It's actually only 100 degrees here today, so I'm inside in the AC and wishing I was back up in Saratoga on Lake George, but no worries. Doing good here, and the baby's doing good too. So
Good.
everyone's good.
Well, it's probably a good segue into this, which keep in mind, we're only probably, I would say, 3 months away from it looking like this in upstate New York. So,
Yeah,
just keep that in mind.
yeah. So if I don't get up in the next 3 months, I'll see you next year.
Yep. I'm coming to you. I'm coming to you with golf clubs and a bathing suit.
Sweet.
Yeah.
Yep.
All right. So, what are we going to do? Obviously, take a look at the disclosures here for Inside Edge Capital. We are a registered investment advisor located in Saratoga. None of this is investment advice. You must be a full-blown wealth management client to receive individualized investment advice. We're going to talk about the markets a little bit. There's no misleading or performance-based content in here, I should say. What's the proper way to say that, Kyle?
Um, we're just providing information on markets and our models. There will be some information on that and stuff we've been invested in, but just because we're showing you one or two things, that's not the whole picture. So if you want to get more information on us or our investments or how we do business, the best way to do that is just reach out to me and Todd and set up a call and we'll talk directly.
Excellent. Okay. Good stuff. So we're going to talk a little bit what's going on the political front, the domestic political front with Trump and some new tariffs. We are, on the back end of Q2 earnings, which have been pretty impressive. There was an interesting $100 billion investment coming out of Tim Cook and Apple. Here, Apple's getting a boost. A couple earnings stories we'll talk about. I'll just do some live market stuff. And then Kyle took the time, based on something that I asked him, to look at estate planning. Remembered Inside Edge, where the two go hand in hand, which is going to be active portfolio management, which our goal and what I really try to do is, we try to position the portfolio such that they lead in bull markets, but reduce volatility and downside by becoming protective in downside markets. And that is, equally as important as good financial planning, which is tax planning, tax optimization, estate planning, and understanding truly your risk tolerance. Like, how else could I say that, Kyle, before we jump into this? And just again, just saying that I asked Kyle to educate me a little bit on estate planning, because I'm certainly by no means the expert. And, I think only when you have a good concrete understanding of what your long-term goals are for your money, your tolerance for volatility, as well as, how to strategically place that money, is when you could go into an actively managed portfolio. How better could I say that, Kyle?
That's well said. I mean, if you want to, you look at financial planning, you look at investment planning, that takes a lot of time and energy to be good at both. So working with an advisor like us, our hope is we provide value on the investment side, portfolio management side, and that we also provide financial planning recommendations, whether it's like risk management or just developing some sort of strategy that isn't really directly related to what you're buying and trading, but other strategies, tax, estate, insurance, savings plan, there's all these other areas that we can utilize to provide value and provide good recommendations, which can, leave you in a better spot than you were if you hadn't done those things. So that's what we try to do with all of our clients, is go through, understand you, make good recommendations that can improve your financial well-being.
Well said. Well said. Excellent. Okay, so like I said, we're going to open up with some markets, talk about the broader economy, markets, and then I want to get into the planning side with estate planning, the good work that Kyle did. So let's keep moving here. While I was testing and working through a lot of technology, Kyle is gonna lead the top here. Talk about what's going on with Trump tariffs, some exemptions, and get me caught up here.
The tariff policy continues to change and evolve on a regular basis. There was some news that came out today about Trump uh, putting on some steep semiconductor and chip tariffs. So the markets reacted to that. He put out this quote you can see on the bottom right, though, and I'll start by, but the good news here in the middle is, if companies like Apple, is if you're, and Nvidia, is if you're building and investing in the United States, which goes back to all of these corporations who did announcements. Apple, Nvidia investing hundreds of billions in the U.S. For manufacturing specifically, and if you're one of those companies, Trump says that there will be no tariff charge on your goods, even if they're produced elsewhere, as long as you're investing in the U.S. And yeah,
Nice.
there's an example of what Apple said. I think they announced maybe another 100 billion on top of that, but 600 billion is a great starting number.
Wow.
It's a lot of money, and so the point is, like, Trump, the risk with tariffs is that they're going to be sudden and overbearing, and they're going to destabilize supply chains and how companies plan. But every time Trump puts out a new tariff, there's like a long list of exemptions for different companies and different ways they can get around it. So it just shows, and it's all about execution, but it does show that this isn't like being used as a tool to like destabilize the economy, or kind of wage uh, create some sort of conflict. I mean, Trump wants stuff built here, and they're going to work with these companies that are important to make sure they're not, don't get thrown for a loop because of
Right.
a new tariff that just comes out of nowhere.
And I'm seeing anecdotally, and I wish I had the artificial intelligence to go and scan all conference calls and all statements that accompany with companies that are reporting earnings. Anecdotally, I'm seeing more and more tariffs have not had the impact that we were anticipating, and the stocks. It's August. It's the first week of August. Markets tend to be thin and overreact a bit, but it's weird. Like, we're in a bull market right now. We'll talk about the hedge that we have on. It's not making money, which is fine because the other stocks are moving up, the other holdings. But it seems to be companies that are admitting that tariffs are not having as big of an impact. They're seeing 15-20% gains after earnings. Like, Shopify is one. Celsius was another one. We had Axon, which is a holding and active ops, that was up 15%. Like, and again, I'm not cherry picking. These are good holdings that are moving up. We do have stocks that have missed earnings, but the market is not punishing the companies that are missing as much as they are rewarding the companies that are beating expectations. And again, one of the common things I'm seeing is tariff impacts are not as severe as they had once thought. So kind of interesting.
Yeah, it seems like the threat is the bit, leading with all these companies that have to do their planning for 1, 2, 5 years down the road, and knowing that the tariffs are out there. That's kind of what Trump's doing to get them to invest in the U.S. And then, like, in execution, he's not trying to throw anyone for a loop and just kind of like destroy their supply chain
Yep.
overnight. Like, he
Yep.
understands and that's kind of the risk, is like, does he understand the intricacies of the global supply chain and all that? Like, yes, he does, and other people there do as well. So we've seen that. We saw it in 2016 with, heavier tariffs, and then everything got relaxed, lots of exemptions. We're seeing
Yep.
the same here,
Same
but
way.
at this on the other side, he hasn't really gotten the results that he wants, I don't think, in terms of like playing the cards that he has, and that. So it's not really, in my opinion, we're still in like the early innings of this geopolitical tariff shift from free trade to where we are now.
Well said. Well said. And yeah, as you just said, I mean, he's paving a way. He's trying to find a way for as much of the fabrication of semiconductors to be done in the U.S. And the semis right now, Nvidia is at new highs. Semiconductors continue to lead the growth trade, and there's kind of a thought that the modern Dow theory, which previously was the transportation stocks, would lead the broader basket of 30 Dow stocks, which I believe it was 15 at some point in the distant past. But the new thought is the Dow theory is being replaced from moving transports out as a leading indicator of the Dow to semiconductors being the leading indicator. So we'll see if that gains any steam. But anyways, let's keep going. Well said there, Kyle. Thank you. So okay, talk to us about what do you got going here on alternative assets?
Yeah, this is happening today. Just got reported this morning that Trump's going to sign an order to, I don't think it'll immediately make the changes, but tell the Treasury Department, or whichever department is responsible for this, to enable alternative asset investment in 401k retirement plans and IRAs. This is something that previously wasn't available, and it basically allows you to do these, more like limited partnerships or real estate investments, direct cryptocurrency ownership. So not, owning the Bitcoin ETF or the Ethereum ETF, but actually owning crypto directly within the 401k and retirement plans. So this is something that, when you talk about alternative assets and just in the context of someone's financial plan, we think that, once you've built up a large core equity portfolio with lots of stocks, cash, bonds, if you do bonds, in the millions, and you kind of have this broad market diversification with all of your investments, that's when you can start look at going into this private asset investments. These are more illiquid, early
Or
on,
liquid.
early stage investments, a lot more illiquid,
Yep.
early stage investments and things that aren't public stocks yet, and cryptos that aren't, could be smaller cryptos and things like that. So, as a planner, as someone trying to build an asset allocation, these are some of the things that people look into once they have that big, broad core equity portfolio in place.
Well said. And we have a lot of thoughts on that one in terms of the private equity, which we need to have that discussion later in the future. But plenty of
Absolutely.
opportunities in the public markets, and there's also a lot of opportunities in the private. So put it on the near term to do list for us, Kyle. Uh,
Yes, definitely. And I know you sent one to me recently. Like, there's definitely some private, early stage companies out there that we could definitely see ourselves recommending to clients to invest in. So,
there- there's just so much opportunity out there. Like again, we're going to get into the hedge. It's like I had a feeling we weren't going to need the hedge, and I'm about to cut it in half. Like every dip is just being bought up right now, and I know we're kind of fading a little bit here, but there's so much opportunity out there right now. I still very much believe we're in a AI driven secular bull market, and this technology is just being embraced and adapted across various industries and sectors, and just increasing the operating efficiency, and it's justifying these higher multiples. Um,
yeah.
all right, before we do
Maybe
that, oh, go ahead.
I was going to say maybe a little FOMO out there too with how
Oh,
markets have been doing. I
for
mean, there's been
sure.
7 trillion plus in money market. A lot of people that didn't like the instability of this year so far with all the geopolitical and economic changes. So there's a lot of people that are saying, oh, okay, now it's time for me to get some exposure again in case you know this economy that's growing with high inflation keeps going like this, because you don't want to get left behind.
Yep. Well said. Well said. Yeah, so let's just do a little bit of a market update here. I know it's not as timely because I messed up the live stream again. Yeah, I'm getting Kyle knows I was not happy. Like, we're a technology digitally based firm, and I've screwed it up for 3 months in a row or 3 weeks in a row. Uh, this is a new platform that I've been going on Mac, and I love Mac, but just this live streaming is driving me insane. But I will get there. But thanks for being so understanding, Kyle. Uh,
But yeah, we'll
and
test it out
everybody,
about
yeah,
eight times.
not so much about you, but
We'll we'll test it about 8 times before next week, and then
we're going to be pre-recorded for a while until we dial this in. So, um, anyways, I mean, I just, for some of the people who are from our old life, I still kind of miss going through the live markets a bit. And I think it's a good time here. So, here's the S&P, and let's just kind of look at where we are here in the first week of August. Um, this is, as Kyle mentioned correctly, FOMO is certainly kicking in because in the first quarter of 2025, there's the big sell-off, and then it's just been an unrelenting move back up to all-time highs in the S&P. So that's the weekly chart. Here's the daily chart. And yeah, we're watching a little bit of a buy the rumor, sell the news into some quite strong earnings reports, from hyperscaler growth stocks. And we did get the sell off, and we saw in our little VIX hedge, which again, let me just stress, our two flagship portfolios on the equity side are SIG, which is strategic income and growth. Each individual company pays a dividend. And then TAG, Tactical Alpha Growth, that's a collection of anywhere from 35 to 50 stocks that we put together in order to try to compete or outperform if we're able to. No guarantees against the NASDAQ, right? So those are the two main. And then the third one is Active Opportunities, Active Ops for short. This is a in and out strategy. I'll hold trades, positions, couple weeks, couple months. We scale in and out. It has no strategy for tax optimization. I will take short term gains. I will take short term losses. So it's for people who want a little bit more activity within the account. So I'll be referring to active ops here in the near term when I say this VIX hedge. It's for those who have money in with active ops. Okay. And is it required for inside edge clients? No. But if you really want to stay in touch and, if things really get swinging, I'm going to try to add some outperformance, in that, but there's more risk with it. So 10-15% of the portfolio is max that you should be doing. We've said that a bunch, but I just want to reiterate that. So, I mean, so the market sold off here pretty well. And I was like, oh, okay, maybe we're on to something here. As the VIX goes up, generally the S&P will go down. So that was August 1st. And here we are now, August 4th, 5th, 6th, and here we are on the 7th. We've recaptured about 3/4 of what we've lost. So, just a little technical analysis here. There's been a few days where we open up. That's that little hash mark on the left, and we close on the downside of the day. So 9:30 in the morning, we're up here. 4 p.m., we're here. Yesterday, we opened at the low, closed at the high. Here we go again. We're opening at the high, and then we're kind of fading off, wondering if some of the tariffs are impacting the market. If it's just a little bit more of a thin August market, we shall see. But if we were to come back here with a halfway through today's session and go back up towards the highs, this is the SPY tracking stock to the S&P 500. we're starting getting up to 635, 636. I'm probably going to take that VIX hedge off and just take a loss on it, which is okay. I should have the VIX right here. So, there's the VIX. We got a little, we did a 23-29 call spread in the VIX, and the VIX went up to about 20, started making some money, and we've since sold off. Okay. So, we'll see. We'll see if we need it or not. Let's look at the NASDAQ before I show you the live positions. Again, the weekly chart is over here on the left. And here's the daily chart. Each one of these bars represents one day. And you can see how strong the NASDAQ is. We're almost back to the all-time highs here on July 31st. Sold off first day of August. And since then, we've been moving up. But again, we opened up here, closed down here. So I like to see where we not only finish today, but finish out the week. We are coming into a seasonally weak period in September. In the S&P, it's the weakest month on average in the S&P. So, are we going to have some sell-off in September? We shall see. The market has been, straight one way rally. I don't mind showing you guys our active ops positions. So again, that's that third portfolio. Here's what we're holding. I don't mind sharing them with you. We can see that, today up the most today is Robinhood. I mean, this thing has just been an absolute beast. And I think what Kyle mentioned with crypto and alternative assets being included in 401k, Robinhood has established itself in the last year or two as, the predominant leader in custodying, crypto and different alternative assets in there. So, Robinhood looks extremely good. I think we're up quite a bit on this particular position. I'll show you the actual live position, the live platform we trade. So Robinhood looks good. DoorDash has been another ripping stock on the upside. And I'm not just showing you. Here's some of the losers on the day. Life 360, still looking pretty good. Daily chart right, weekly on the left. And in this portfolio, I'm in the habit of cutting the losers and letting the winners run. Right, and that's just good discipline of a trader who's been doing it for a while. I love to cut the losing ideas and no ego tied up in it. You're going to be in the right position sometimes, and you're going to be in the wrong position sometimes. The difference between a good trader or a portfolio investor is somebody who has their ego tied up and always being right. And you just need to do this game long enough to be humbled and realize you're not going to be right. Probably you're going to be right more than you're going to be right less than you're wrong. You're going to be wrong more than you're right. You just can't have your ego tied up in it, right? So there's Shopify, Roblox. This is a fun one out there. Those of you who are Major League Baseball fans, every time they say StatCast, the statistic brought to you by StatCast, this is the company that powers it. So we've had that one on for a while. So just kind of talking about some of the fun things. I'll show you the live portfolio that we're in. This is the actual Schwab Thinkorswim institutional ThinkPipes platform. Here's all of the positions sorted by P&L. So the biggest one is Palantir, up 85,000, Robinhood. And then here are the losers down here. The VIX were down 14,000 because the stock market has come back. So, okay, it's fine. As I said, if we get a stronger close here today and into tomorrow, I'll probably reduce the size of this position. I think we have 1,200 contracts on the VIX hedge. Probably cut that in half and begin to scale out. So, that's that. But all in that, the idea is to continue to press the winning trades and add where we can and reduce the ideas that are not working. There's two that I also want to show you that I just kind of find interesting and fun here on this first week of August. I'm pretty much to the point where, Kyle, I like coffee. I like Celsius more than coffee. I've been in on this trade I've been watching Celsius for years now, and this thing has been an absolute beast. If you go to the 5-year chart, Celsius back in 2021, 22, went from 20 up to 90, sold back down to 22, and here we are coming back to 50. Well, just overnight, they reported earnings that absolutely destroyed the expectations, and the stock went from 43 up to 53, selling off a little bit, but the stock's up 60. Yeah,
If I remember right, last year or at some point they had kind of mismanaged their inventory and they're oversupplied some of their people, their vendors, so they
correct.
saw, a big upfront order, and then that order was done, so their sales went down. Everyone was disappointed, and now they've kind of gotten back to equilibrium, I guess you could say, or just kind of a normal sales log.
Yeah, you're absolutely right. And there is and I just started using Benzinga Pro for better news, but there was an article in here with, and the earnings just came out this morning, how they have improved the management of their inventory, and that Pepsi distribution deal is really big, and that was kind of tied into it. But I think they righted that, and then the acquisition of Alani New is also now adding to the bottom line as well. So Celsius is one that we're not currently in, and I hate seeing it up 16%. It was up 20% today. And then another one that came out on earnings, Kyle, I don't know if you saw this one, was AppLovin. That was a holding and tag that we cut probably a month ago. They just came out with earnings, AppLovin, and they were pretty stellar. So stock's up 10% today. And if we just look at the technicals of AppLovin, you just kind of look at, when we keep knocking on the door 3-4 times of a certain zone, that tells you that buyers are back in control. There was a story out there by aggressive short selling company research. They had a short position that there was some rumors that AppLovin, which is like essentially the dating match.com with app producers and advertisers, there was hidden Chinese ownership of this company. Got to see how that has shaken out or not. But you just look at, the fourth test now of this $450 level. If they've sort of cleaned up that bad PR on Chinese ownership that was undisclosed, maybe the stock can reemerge. So those are two stocks that we are not currently in on active ops, and also in tag, that we should be in. So, we always got to present a fair and balanced outlook. So those are two screw ups that I had. But I just wanted to share that with you as well. Finally, we'll just take a look at, and again, I don't mind sharing the positions that we're in both tag and sig. Granite Construction, this one also came out with earnings. This is an industrial construction and engineering, and it is looking like it wants to break out. I've got to get inside the news on this one. DoorDash, the stock has been amazing. Robinhood, Apple. What I also like about Apple is on the daily, based on that news, starting to break up through this $215, $216 ceiling that's been in place. 200-day moving average at 222. And if we can get Apple coming out, plus I also read that the new iPhone 17 is going to be sold in the next couple weeks, or maybe in September, maybe in the next month. This has fully embraced artificial intelligence within the iPhone 17. So they're saying the massive upgrade cycle with Apple is going to be upon us. So it certainly helps when you have Apple breaking through that resistance and you have NVIDIA right at all-time highs. So circling back to the VIX hedge, perhaps we don't need it, and it should be a loss. Down in the day, OKLO, this one is, it's down 6%, but you can see on the daily chart, it really doesn't look like much because the average percent that this thing is moving per day is quite significant. CrowdStrike, that one's kind of looking a little nasty. I'm also seeing Cloudflare, which is net sell off on cybersecurity. So don't love the looks of that. ServiceNow, SMR, and then A-Lab had a huge update yesterday. Astera Labs on earnings kind of selling off a little bit. So just kind of showing you what's going on in the overall market, sharing the portfolios with you. And again, I don't mind giving you the positions. It's the management of it, I think, is key. So that's just a little bit of a market update. And I want to turn it to Kyle as we move into planning.
Yes. So anyone who's been waiting for us to spend a good amount of time talking about estate planning, today is your lucky day.
I love it.
We have a lot of information here, and it's a lot, but it's also just a primer. I mean, estate planning, there's a lot of different things you can do. There's different levels of complexity for an estate plan, based on different factors like your asset level, asset type, how much you want to avoid estate taxes, or the risk of not having control of your assets. So these are all things that talk to an advisor, talk to an estate attorney, find an advisor that'll work with your estate attorney directly, and help you get a plan that not only put in place but implemented. That's what we're trying to do with estate planning. So a couple of bullet points on what we're going to cover. There are things that I think are essential for everyone to do. Then there's kind of your next tier, which would be I would call a simple estate plan, where you're not really at risk of hitting the lifetime exemption, which is the amount of assets you can pass on without paying an estate tax, which is currently 40%. If you are at risk of that estate tax, if your assets are high enough to where you're kind of wondering if that's something you want to plan for and avoid, that's when you get into more complex estate plans. Put in just some notes on which might be appropriate between a simple and a complex plan, just to give you some context, and then a few just steps on what that process would look like if you do go through and update your estate plan.
Okay. Nice. I follow you so far.
Yeah, yeah. Let me know if
Oh,
I'm
I,
trying to stay in the tall grass. I don't want to get totally into the so, so tell me if I'm going
wait,
off
wait.
off reservation.
I'm trying to stay in the short grass or the tall grass.
Either, as long as I'm not just
In the
like
weeds.
completely saying things you don't understand at all. I want Alice to understand what I'm saying.
Perfect.
Um, so these bullets here, this is what I would say that regardless of what assets you have in place, like pretty much everyone that's a U.S. citizen needs these elements to have a level of preparedness. There's a stat at the bottom that 76% of adults lack a will, according to a study this year. I would say some of those people don't have as much assets to leave, but there are so many people with a house, with an investment account, other assets that are just going to go into public probate and get split up by an executor if you don't have a will. So, and then every state has its own kind of process for doing that. Some are better than others. So it's something, these are all things that I think are critical, really. The first one is having that last will and testament. This is your way of putting into writing and certifying how you want your assets to be distributed, and naming guardians to and an executor to administer your estate. The next ones are powers of attorney. Um, Both the durable power of attorney, which manages your finances and legal matters if you are incapacitated. So if you're alive but incapacitated, how do you want your POA to conduct and manage your assets in the event of your incapacity? So that one's important. The other one here,
Can I interrupt you real quick? I'm going to
yeah,
totally put you on the spot.
sure.
Are you following this Jimmy Buffett saga with his widow Jane Buffett and their financial advisor? Just
I'm not, but I know we've talked about. I think we talked about it when I was up there, and I hadn't heard of it. But I mean, it's
okay,
crazy that someone with an estate,
of that
and
size.
and I guess a brand with value, and his whole catalog, like that's something that I can't believe he didn't have a plan in place. And
Well, he
could be a
did.
lot
It's
of
just
reasons.
he did, and I'm gonna task you, if you don't mind, like I don't need a big report, but give me the highlights of exactly what you think went down with this. Let's come back next week or the week after. Like
Yeah.
it's just, he did have power of attorney, but in terms of, I don't know. I don't know. I want you to kind of interpret what you think's going on, because it's what we're
Yeah.
talking about here, but it's on, $1 billion scale.
Right. And I mean, without knowing exact details, like you can, or someone can challenge your will and your estate and take you to court. Like that totally happens. So there are ways you can move assets out of your name into an irrevocable trust that takes it completely out of your estate, and
All
that's
right.
a big thing. Like I mentioned with those complex estate planning tools, it's a way to um, put the asset out of your name entirely, so that if someone wants to challenge for that asset, they're not challenging you; they're challenging a trust document that was put into place and a transfer, and it's a way to add protection. So that's something that definitely needs to be in place when you have a legacy like Buffett.
Okay. All right. Well, there's a lot. Okay. Fine. And usually CNBC has concise articles, but
Yes,
well,
bullets.
yeah. Well,
I do see the word growing litigation.
where's that? It highlighted the growing litigation over trillions of dollars. Okay. Yeah.
So
Filed a
that's
position last week to remove her co-trustee for marital trust creative support. Okay.
and there's a
Okay.
Gary Player, I think, had one. The
Oh,
profile,
really?
he's still alive. I mean, you'll see managers and like totally mismanagers, I guess, but you'll see managers like make claims on people's estates and like non-family members. So it's, I mean, this is something you need a fiduciary. You need someone that's unbiased, that's not too close to your affairs, or like having someone that does everything. I mean, you really, if you're someone that needs to put a plan in place, the best thing to do is to find a fiduciary, an estate attorney that's not also like your manager or something like that,
Right.
uh, to set you up with a plan that, like, given everything that is important to you, and then also your balance sheet and what types of assets and goodwill, if you're an artist and have a catalog, like all this stuff needs to be considered and protected.
Dude, like, I, dude, how professional do I sound saying that? But it's like, but that's what I love about this business is what we do is it's so not complimentary. It's too soft of a word. It's so required to have this planning, and what we do is so different. I really am just buried in the markets trying to extract the most value and alpha for our clients as possible while minimizing the volatility, beta. But what you do is so different than what we do, but the two go hand in hand. That you can't.
Yeah. Why go to all that work of building a nest egg and then don't protect it? Like
Or
it's
and vice versa. Do all this tax planning and all this tax efficiency to at the margin, all planning. Obviously, you want to protect your assets, but planning to maximize your tax responsibility, but then go with subpar portfolio that is underperforming the index to begin with, and then some guy charging you 1% to underperform. Like
yeah.
they're so different, but they're so required, and they're so just joined at the hip. Anyways, sorry, I'm going to shut up now, but please keep going.
Yeah, no, that's spot on. Durable power of attorney, got to have that in place. There's also, I put in advanced healthcare directive, which is like a medical power of attorney. Different states may call it medical power of attorney or advanced healthcare directive. I think there's one other designation, but it outlines your medical wishes and appoints someone to make decisions, again, if you are incapacitated. So both of those, I would say, on the POA level, are the two big ones that you want to have.
Interesting. Interesting.
Setting up beneficiary designations is also important for any asset that doesn't have a named beneficiary. The reason that you want to do that is to ensure your assets avoid public probate court, which is a lengthy process. In college, I worked at a law firm. I was a clerk, always running up, and this is in Lubbock, Texas, where we still did things paper back then. So always running back and forth to the court to do probate for our clients, and it's a lengthy process. It's public, so anyone can look up your assets if they go through probate. So uh, assets, basically everything that's a taxable asset. This could be a taxable investment or a house, personal property, jewelry, cars, etc. Needs to have direct transfer set up, and different states have different ways to do it. But it's something that you can designate, or in a lot of cases, or some cases, you might want to put those assets in a living trust, which I'll get into on the simple estate planning slide here in a minute. And then one more thing, the digital asset plan. So, you know, basically everyone's file box now is kind of half online and half in paper, probably. You want to make sure that you have all of your information, all of your accounts written down with passwords for your executor to be able to just obtain everything and know where it's at. Anyone who's ever been an executor um, probably has an idea if the person's estate they were handling was organized or not. It can be a massive headache. So anything you can do to help your heirs, your spouse, everyone have some continuity after you're gone is a good thing.
And that does not mean you should have the same password for every login.
Yeah. Yeah. Ideally, yeah. And ideally, and we use, me and Todd both use these, but there are password managers with a lot of security. Like Dashlane is one, LastPass is another. I think Apple and Google have their own password managers now. So just making sure, like, just spend the time, for whatever, however much time you spend getting all of your stuff that you set up yourself organized. It's going to take someone else, 5 times, 10 times as long to figure everything out if you're not there to show them.
So two quick points, and these are to our clients only. If you want help, Kyle and I use different password managers, but it's life changing. Like one password goes in, and then it's got, you get long, secure passwords for all your different things, all your different logins. I couldn't live without it. If any of you clients want sort of help in how to maybe go about it, let us know. 2, Kyle.
Yeah.
What do you, and maybe I'm putting you on the spot here, like with that, there's got to be a download in LastPass and Dashlane in order to have those in hard copy, right? To put into, to hand into your whoever's in charge of your POA.
You would think, yeah. And it would be something that, yeah, if you were using one of those, you would also want to make sure that your POA, your executor, your spouse has a way to get into those accounts.
Yeah.
They're very secure. And that you don't want to set all that up and then have someone have your executor have no way to get in there. But they are very secure for good reasons.
This is a story for another time, but oh man. There was a client of mine at Trade Analysis. He followed me forever, retired airline pilot. I went to his house, did a YouTube channel or YouTube video with his friends. He was a friend of mine. He was wonderful. He started a retirement fund for airline pilots, managing their pensions. He's one of the reasons that I got into finally pulling the trigger to wealth management. He passed away from a heart attack, and I had high up, I had the third or fourth in charge at United call me, and he's like, Todd, James used to speak about you. I'm here trying to pull everything apart. It was a mess. It was hard to get into his different passwords and get into the account at Interactive Brokers, and it wasn't a lot of continuity on that. So I had a lot of people calling me asking for help. Sorry for another time, but I was like, wow. Got it.
Yeah, and related to that, and I believe I mentioned it here too, but one of the values we provide as an advisor is storing your information on our secure servers. Anything estate related that you want us to have to be able to share with your beneficiaries, your executor. That's part of what we do too, is help you stay organized. Uh,
Nice.
so yeah, maybe we put out a separate communication and help everyone make sure they have a digital asset plan in place if they don't already.
Well said. Okay.
So, busy table here, just to lay out kind of the broad differences between a what I'll call a simple estate plan and a complex estate plan, and the basic, you know, I guess motivation between doing one or the other is whether or not you're worried about or you're within striking distance of that lifetime exemption. The lifetime exemption is the amount of money you can pass from, through your estate without paying the estate tax, which is 40%. That amount is 15 million per individual or 30 million per couple. It is an amount that is changed by law by Congress. So while it's a high number right now, there have been years where there's no estate tax or no estate lifetime exemption. So unlimited lifetime exemption. There's also been years where it's very low, like in the 5 millions, just in the past 10, 15 years. So that's kind of the break point. Going into the core tools of each, the simple estate plan, that's going to be more setting up those essentials, along with perhaps also setting up a revocable living trust, which I'll get into in the next slide, and an umbrella insurance policy, which I'll also get into soon. The main goals: avoid probate. Like I said, you don't really need all that to be public if you can avoid it. Make sure you're covered in the event of your incapacity. All your wishes are being adhered to, and then just liability protection, which is what that umbrella insurance policy is able to do. As far as trustee, you're keeping in a simple estate plan, you're keeping all of your assets in your name for the most part. So you are the trustee, and then what you do is you name your successor trustee. Could be a spouse, friend, advisor, or a independent third party like trustee company. The cost of a simple estate plan relatively low, and it's usually one time. Just making sure getting all of your um, basically everything that you want in order, drawing up your living trust, purchasing your umbrella insurance policy, wills and POA would also be done by an estate attorney with the trust, and then you're pretty much done until you need to make changes or review everything.
Okay.
The net worth for having a simple estate plan, I think it's appropriate. This is hypothetical. It's generally speaking, um, but I would say if you're under 5 million per individual or 10 million per couple, that puts you basically 10 to 20 million below the lifetime exemption of 15 million per individual or 30 per couple. And that, in my mind, two things. One, they could lower the lifetime exemption in the future, and it has gotten down to around 5 million before, just in the last 15 years, like I said.
Yep.
The other reason is you don't know kind of what your ending net worth is going to be. You're still working. You have a lot of expected income or a windfall, and you just want to get ahead of it and just know that you're not going to have to worry about paying estate tax as much as you would otherwise, and then that you're also okay with like the higher setup costs of a complex estate plan, which would actually be moving your assets out of your estate while you're still alive. So, a couple of complex estate planning points here. Um, Under goals, in addition to those basic protections, you want to minimize estate tax. You have business succession. I'll also add if you have a blended family where you want to have a more complex distribution of your estate, that's when a complex plan might come into, and then philanthropy, and then a multi-generational legacy, which would be like setting up a trust for not just your kids, but like kind of your dynasty or your family limited partnership.
Let me-
Austin, yeah, go ahead.
No, sorry. Tell me if this is not a good time to interrupt.
No, you're good.
This is gonna be dumb, probably dumb question. So talk to me like, I'm not a certified financial planner. That Let's say somebody has a significant IRA, right? They need to pay tax on money that's been deferred. It wouldn't be a Roth. Step up
Mhm.
cost basis is still in play, right? So let's say an investor passes, the still to be taxed IRA is going to be inherited by the children or the beneficiary, right?
Yeah.
This
Uh,
they
the step up is for taxable assets.
That's what I mean, right?
Well, yeah, exactly. The IRA gets taxed the same, whether it's you taking it out or your beneficiary. It gets taxed at the marginal tax rate
Of
of,
of the
you know,
of whose
yeah.
tax bracket. But if it's in a trust, like is it how to determine what the tax bracket is?
Based on whoever distributes it. And then for IRAs, you can usually get away with leaving those out of trust
Oh,
because those are called POD, transfer on death, or POD,
oh.
not the band, but payable on death. And those would just avoid probate and go straight to the beneficiary. There's no taxable event on an IRA.
So those would stay out of the trust then. The
Yeah,
most
exactly.
Okay. See, I was going to say if there's significant gains on that in that taxable IRA that puts you on the border between 5 and 10, between simple and complex. My question was going to be whose tax bracket is assigned to what the tax bill is going to be, and does the value of this state based on the expected taxes are going to be paid, does that reduce the value of that estate based on what taxes are due? If that's a dumb question, tell me.
So I'll talk about a taxable brokerage account, for example.
Okay.
There is going to be income in respect of decedent, which will be income in that year of the original owner passing. That'll be taxed to the estate in a final tax plan.
Okay.
Uh, there will be a complete step up in basis for any taxable assets upon transfer. So that's something that, if you bought Exxon a long time ago, or you have an ETF that you just never touched, and there's a lot of gains built up in that account.
Yeah.
And it's a company or a fund that you aren't worried about losing any capital appreciation or going down, then I say hold it. Just hold it and get the step up when you pass. As long as you don't need the money, that can be a great strategy to avoid those capital gains taxes.
Got it. Okay. All right. Well, thanks. Um, are we good on this one, or is there more on
Yeah,
this one? Okay.
yeah, we can move forward.
Okay. Good. This is all good.
So first, I wanted to get into simple estate planning a little bit more, and I've got basically a description here of what I already mentioned. If you're well below that lifetime exemption, somewhere under 5 million individual, 10 million couple, that's generally speaking, it may be you may have different concerns that would move that kind of break point up or down. Then you probably just need a simple estate plan. Went through the focus already on the previous slide. And then four common tools here. The first is that revocable living trust I mentioned, which is a trust that you set up during your lifetime and title your assets to the trust instead of yourself. You are the trustee of the living trust. that means, and revocable means that you retain control. So it's still in your estate, and you can update it and dissolve it whenever things change. If you have new assets come in, you just title them in the name of the living trust, and then whenever you update that trust document, all of the assets within that trust are going to be managed in accordance with the updated trust language. So it keeps you from having to update a lot of stuff. And then lastly, it's going to avoid that public probate court if it's in the living trust. So common items we see put in living entitled to a living trust is taxable investment accounts, houses, and then other personal property like cars, jewelry, anything that you want anything with value that you want to be in the trust, you can add it to that, title it to that. Pour over will, it complements a living trust. It's a will written with language where untitled assets go into the trust upon your passing. So that way you don't have to update everything as you get it, or go back and update everything that you've had. The pour over will take care of that for you. But for simplicity, everything that you can title in the living trust, like I wouldn't rely on the pour over will for everything. In execution, you want to get everything titled into the trust, and not rely on the will entirely, just for simplicity. Power of attorneys, I already mentioned. There's the name for the medical. It's either a medical POA, a healthcare POA, or an advanced healthcare directive, depending on what state you're in. And then lastly here, umbrella insurance. Umbrella insurance is liability protection for lawsuits against you. If you have, house where you're having people over a lot, and someone, trips on your boat dock and gets hurt, they want to sue you. Your homeowner's insurance would be part of that. And then whatever isn't covered would be covered by the umbrella.
Yep.
It's very affordable coverage. This is a ballpark estimate, but I've seen $1 million of coverage for like $300 of premium per year. You want your coverage, your total coverage, including homeowner, automotive, everything, and umbrella, to be more than your net worth or your net assets. So that's an important thing. You want your coverage to cover all of your assets if you get sued. That way, if you do, they're going to be dealing with the umbrella insurance and not coming after your stuff. And then, there are other ways to protect your assets, but this is, for what you get and for what you pay for it, I think it's a worthwhile thing for most people to have.
Right. I mean, you playing golf, right? I mean, what happens if you slice the drive right and unfortunately you connect with someone's noggin? I want you to be protected for more than your net worth. And, I want you to have more because they could come after you for who knows.
Yeah, and the odds of that happening when I am hitting a golf ball are pretty high. So
I don't mean to be laughing, but so another question: what are the benefits? And I remember as I was going through the Series 65 studying, but quickly, why would someone go for an irrevocable trust over a revocable trust? Is there?
yeah, so let's go to the next slide. It's a
Okay.
good segue,
Okay.
because that's where you go into complex estate planning mode when you are looking at revocable versus irrevocable.
Okay.
What an irrevocable trust is going to do is take assets, and this is the irrevocable part. And you can't go back once you do it, or you can, but it's painful and costly. But you're basically gifting assets into another entity that's out of your name and your control. Once you do that, it's considered out of your estate. And basically, the reason people do it a lot of times during their life, get assets out early, is you're basically transferring those assets at their current value. and then any income or appreciation in that asset that happens after you've transferred it is out of your doesn't go towards that lifetime exemption.
Got it. Got it. Got it. Got it.
Yeah, it's a way to do it early and to like chip away. There's so many ways you can chip away at your lifetime estate, whether it's just gifting to your beneficiaries. There's an amount you can gift. It's in the 30s that you can gift, 30s if you're a spouse, if you're a couple, 18, I think it's not, but that, you could be doing that every year to kids, grandkids, paying tuition. And then on top of that, there's these trusts that I've listed here, these common tools, different types of trusts for different purposes. Like if you were already planning on giving a significant amount to charity, if you wanted to get ahead of your business taking off and put it in that family limited partnership, or I'll cover this more, but this qualified personal residence trust. That's a way to transfer your personal residence to your beneficiaries in a way that gives you a discount on the value of that property. So based on what you're doing, it may make sense. And it's kind of you kind of have to think through it and make sure you understand what exactly you're doing. But there are ways to transfer your assets out, still get to enjoy income, and also see the benefit of minimizing that estate tax.
Well done, sir.
So
You're
I can,
quite.
I'm trying so hard not to like go down all these rabbit holes.
I think that's going to be good for the initial conversation on trusts
Yeah,
and
and I
estate
did
planning.
put a couple examples of these to go into on the next few slides. So I'll gently foray into the weeds on these next 3 slides here. Just to give an example of one of these tools, this one is called a Qualified Personal Residence Trust, or a QPERT. It's an irrevocable trust where you gift your residence into this trust at a discounted gift tax value while continuing to live in that house, in your house. It's personal residence trust during a set term, 15, 20 years. That immediately removes it from your estate. If you die during that term, the home reverts to the estate. No harm done. If it's post that term, then it goes to the heirs. So it's in their name, but you still have the right to use the residence in an agreement that you can make with your heirs. And then what you can also do if you live past that term, you can rent at fair market value your house from your heirs and pay them rent, which isn't a gift. You're paying them rent, so that usage is not in your estate anymore. And it basically
Wait,
gives
this is
you
after the term is expired. The preset term is expired.
So you're still alive, and then you're basically renting, which is paying your benefit. The heirs, you're paying them gift tax free to live in this house, and then when you pass away, um, then they would get usage and control of the
Do,
house.
does that rent that you're paying your heirs become taxable income for them, or does that go somehow to the estate?
Um, I believe I believe it would be taxable for them, but not for you. And that's something I would have.
What if I'm using it as a business in location for my business that I'm then paying business rent to my? I'm kidding with you, but wow,
Throw a business entity in there, but
wow.
if you have a significant residence, I have seen people do this before, and you know, we saw during the pandemic. I mean, we saw a lot of, especially down here in Austin, prices on homes go up 50%. So before they went back down a little, but just imagine gifting your residence at 2010 prices and then living in it for 20 more years, and then also getting being able to pay rent out to your heirs too if you live past that. It's a nice tool to have.
So here's another question: if they eventually sell it, the capital gains on that, do you know, would it be like the same thing, a step up cost basis for the fair market value when it goes into the trust, or is it from when you bought it?
I believe I'd have to double check that one.
Okay. And then the next
Yeah.
question is it, can they what 1256 it and then can they roll it into something else? I don't know. At some point you need to go ahead. Go ahead.
Yeah. The trust would actually own it while you're alive. So anything there would be taxed at trust rates. I believe at the end of when you pass away, I believe the trust would distribute it to them, and then it would be taxed as as a probably a non-residence asset if you're looking at multiple heirs. But yeah, it just depends on who, if someone's actually living there, that'll qualify you for some exclusion. And then as far as step up, I'd have to double check how that works.
Okay. And then the next question again, you got to bring a CPA in at some point here. But
Yeah, exactly.
if you did that for your kid, and then could they roll that 1256, exchange it so they don't pay cap gains on the residence that was gifted as they buy their own house?
An investment. Yeah, maybe.
Wow. 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 Wow.
Right.
Listen, I'm going to tell you this right now. Like going through the macro markets, looking at fundamentals and earnings and projections for the companies that are leading this AI transition. And sorry, I don't want staying humble in the market and do anything, but it's easier. What I have to do, I think, is easier than what you have to do. I'm going to be honest with you. But
Yeah, I mean, there's so much, and the IRS and case laws made stuff convoluted for and so if you do want to do one of those things, have the advisor that can help you with execution, have the CPA, have the estate attorney, have a full team where we can help with strategy and execution. CPA can help make sure the IRS is not going to get mad at a trust document being set up incorrectly, and then also tell what you're going to be capable of later on, and then have the estate attorney to draw everything up and help with strategic planning too. I mean, if you get those three arms to your planning together in the same room, then you can be pretty confident that things are going to work out the way you want.
nice. All right. I'm going to stop sidetracking you. You got a lot of good content here.
Good questions, and yeah, without keeping this going for another 2 hours, because I probably could.
Do you
One more
want to keep
example.
going, or do you want to break this up for part two?
Let's keep going, and I
Okay.
think this should be its own estate planning primer that we put out on YouTube, kind of on its own. So people, if they want to dig into that, they can just go straight to the estate planning part of today.
I'm well ahead of you, brother. I'm already thinking of that. Yeah.
Yep. So next one here, this is not a complex estate planning technique, but it's one that I use quite a bit with clients. It's called a donor advised fund. Basically, with a donor advised fund, and I'll summarize because you can read the points in here. You can front load your retirement charitable giving during your working years. So say you're giving 10% of what you want to earn, or what you earn, and you want to continue doing that, or whatever your plan is, you can front load a charitable contribution into a donor advised fund, take the full benefit of that charitable contribution in that ideally high tax year where you're getting more deduction for what you give. That money goes into the donor advised fund, which is then invested and given the chance for capital appreciation tax free until you make the grants, which there's no timeline on or time limit on how long the money can be in the donor advised fund, how much you have to give every year. You could start a donor advised fund today and let it run for a few years, and then, ideally be able to give a larger benefit or a grant to your charity with tax-free growth. So pretty awesome for planning in terms of, if you are a charitable person, if you are having some high income years, if you want to fund a giving plan like throughout the next few years or throughout your retirement, we can do an analysis, tell you what a good amount to put in the donor advised fund is, and then be able to invest those funds for you in the meantime until you give them out.
Well done.
And then I got one more slide on this. It's more of a use case. Kind of described it, but basically a client age 65 working maybe a few more years, 2 or 3 more years, wanted to give 10% of his working salary to his church and then other charities. And so what a recommendation from us might look like is to front load a newly created donor advised fund with 5 years worth of charitable contributions, right? How much are you planning to give those first 5 years of retirement? Let's put that in the donor advised fund now. It's going to be invested until you retire, into retirement, until you write those or do those grants, which are, even though this is its own account, you are the grantor of that account. So, and you can name a successor trustee, so you can decide when that money goes out. What you can also do is help cover charitable distributions with a qualified charitable distribution. So this is separate from the donor advised fund, but this is another thing. If you're charitably inclined, I see a lot of clients and make a lot of recommendations. Start the donor advised fund and plan on doing qualified charitable distributions. What a qualified charitable distribution does is it when you hit your age 73, 74 based on the chart, but when you hit the age where the IRS says you have to start taking this amount from your IRA or your 401k, you have to start taking that out of your account every year and paying a tax on it. If you'd rather that money go to charity, you can direct your RMD that up to the full amount of your RMD. You can direct that to your charity of choice without it hitting your account for a full exclusion from taxable income. So not the 30, 50% that you are able to deduct when it's a normal gift. If it's an RMD and you do a qualified charitable distribution, that none of that money goes onto your taxable income. So that's pretty huge.
When do you have to designate which charity is the recipient of these distributions?
For either, it's whenever you send the distribution. So if you wanted to do one charity 1 month and pick one another month, through Schwab, they offer donor advised funds, and they have a list of every registered 501c3. So you would just go in, pick the charity, pick the frequency. So if you want to do like 100 every month, or if you want to do a one time, you can customize it there. Same for the qualified charitable distributions. As long as it's a certified 501c3, it'll pull up on the list, and you can send it directly.
Dumb question again, and other clients who are listening to you intently, and I'm probably going to sidetrack or push the conversation backwards. If you contribute to a DAF, are you immediately reducing your taxable income for that year?
That year, yep.
So
you don't get a taxable benefit or a tax benefit when you donate it to the charity. You get it when you donate it into the donor advised fund.
So that's
why it's great to do it while you're front load kind of while you're still working, especially in those last few years if you want to fund.
So here's my question: Why would you donate to a charity from within DAF if you're already receiving the tax benefit that year? Why not let that money grow in the market and you set some time in the future and then you donate more?
People do. Like I said, there's no time limit or amount that you have to give. There's no RMD for a donor advised fund. It's actually a bit of a sore subject for some because we have seen donor advised funds that have basically grown with no intention of ever distributing the money. Um, so that can happen, and there's nothing stopping you from doing that.
No, no,
And
I'm at,
stuff where you're like, hey, I want my successors to be charitably inclined. So I'm going to put this money in for them to gift, for them to find.
wait. No, no, no. I don't. You're
Yeah,
making me out to be a cold-hearted.
no,
Yeah. See, no,
no,
but
I'm saying it happens.
no,
Like,
no, no. But wait. But I'm asking is why not say if you're contributing to DAF, reducing your taxable income, why not say this date 15 years from now, anything that this money has appreciated into goes into charity, and that's is there like a letter of a letter of direction to do that? Because why contribute every year with unappreciated money to your charity if you're really charitable? Let it grow, or do you just want to show the charity that you're working with that you're contributing to them? You know what I mean?
I kind of know what you mean. I mean,
Why
I
not?
think it's
If you put a 7% return on, let's say $10,000 every year for the next 15 years, you're going to be giving a lot more money 15 years from now in one big shot,
yeah,
rather than donating that $10,000 every year.
for sure. That's how I would do it, and it's for the immediate tax deduction. So
Right.
people like that, and then yeah, the sooner you do it, and the longer you wait, the better.
The better for the charity.
Yeah, and so there is a floor for when charity becomes deductible. If you are doing smaller amounts every year, like, and you may not even see the benefit on your taxes of doing it because you're donating at a rate, and then you have your other itemized deductions, right? But your itemized might not even make it worth it to itemize it all and just take the standard deduction when you do like a smaller yearly contribution. So this would
Okay.
be a way to be like, hey, this is a high income year for me. I am charitably inclined. I want to get a plan in place for the future. It could be 15 years in the future easily. No harm done there. It's a good thing. But I want to get the benefit now. And then I want to be able to donate enough in any single given year where it makes sense for me to itemize versus just take the standard deduction.
Okay. Gotcha. Gotcha.
And then one more thing I threw
Oh,
in
do you
for
have me
you.
to go
So you
back?
said, yeah, good.
Yep.
The DAF, it's the second bullet point here. The DAF was funded with appreciated company stock, which, if I don't know if y'all are aware, but with taxable investments, you can donate a stock. So I'll lay out two things. You can sell a stock, pay the tax on it, and then donate those proceeds to a charity, and then you would get to deduct up to whatever cash proceeds you had to the charity. Or if you don't sell the stock and that nonprofit has a brokerage account in place, and you transfer that money, you do a direct stock transfer without selling it to that charity, then you avoid paying capital gains on the appreciation of that stock. Does that make sense?
It does.
And I've seen some people take advantage of that. Even when I was, on sitting and was the treasurer for Autism Society of Texas, we had a brokerage account. We had donors in town that worked at companies with stock plans, and we had one reliably every year, and then a few kind of one timers that they were donating their company stock and avoiding, a lot of capital gains, short term and long term, on the appreciation.
Okay.
So it's another nice little
Wow.
trick if that's your priority, and then yeah, you can move on now.
Okay. Wow. This is good.
Yeah. So two to three more busy slides. I wanted to do a profile of how this looks when you're working with us through your estate planning, how this looks. So I've got a profile here, married business owners, 20 million net worth currently. Um, Priorities are avoiding a 1.857 million projected estate tax. They want a charitable giving plan; it's a priority for them, and they want a business succession plan. So you'll see on the right a comparison of two different scenarios. The one on the left is without recommended changes. The one on the right is with recommended changes. And those changes are here in the bottom left. So you can see 100K annual gift to charities, paying for each grandkid's private school, 30,000 annual gift to each of their kids, 60,000 college for each grandkid after the private school, donating 50% of their company stock to a charity trust, doing an ILIT, which is an irrevocable life insurance trust. It's a way to transfer wealth and avoid paying estate tax. And then also the property, the personal residence trust, the Cooper that I explained earlier. And so you can see with those changes, what our software is able to do is show you the difference. How much gets transferred to charity, how much gets transferred to heirs, both within uh, the estate and assets that no longer belongs to the estate. So that would be the heirs assets here in blue. So you can see before any changes were made, about 3/4 of the estate, the net to heirs part, which is 73%, that's all within the estate. And then you can see like 20% go into heirs assets or gifted into these assets before the estate is executed, and then 5% go into taxes and expenses. After the recommendations, with these irrevocable trusts and with the gifting, you can see that blue part actually go to 40%. So with this plan, 40% of the assets are out of your estate while you're still living. And that's going to reduce that net estate. It's going to reduce the taxes paid. So you go down by about $600,000.
Holy cow! It took me a second to get caught up. This is the fourth client to text me saying, "Hey, what happened to the live stream?" And I'm like, "I'm sorry, I messed it up. We're recording, and it'll be sent to you shortly."
Yeah, I know we're going long here, so
you're
have some fun,
dude. This is a master class in planning. You're crushing it.
Yeah, and I wanted it to be like enough to just start that conversation. So if any, whatever part of this is resonating with you, feel free to reach out, and we can just pick up wherever you want to on the stuff.
I have so many questions. All right,
We'll
and
do it. We'll have to do a second.
We're gonna have to do a lot more. The other thing I got a problem is I got a dentist appointment 20 minutes, and I'm gonna get yelled at.
I have 2 more slides, and then you can go have fun at the dentist.
Oh.
So this is our software, and then I also wanted to expand on that profile from the previous slide. E-money is what we use. It incorporates all types of trusts listed. So if you're talking about these specific trusts, these irrevocable trusts, there's a number of them. We can model in different types of trusts the way they're supposed to be through the software. And then kind of as I've illustrated, we're able to run different scenarios. Here's what things look like now. Here's what things look like if you make these changes. And then we can run many different scenarios showing multiple plans. And so this table, again, you can see the blue, the same colors from that previous pie chart. And you can see the effect of what those estate planning strategies have. Increasing the blue, which is assets that have already been passed on to heirs, versus the green, which is what's still in our client here's taxable estate.
Interesting. And just to reiterate, you said it quickly, but eMoney is the financial planning software that Kyle uses. And eMoney is it fair to say it's used by billion-dollar wealth management shops? I mean, it's very high end.
Yep. It was bought by Fidelity probably a decade ago, somewhere in there. And it's kind of it's the software, and there's a million different planning softwares, but if you wanted get as granular and detailed as possible, then e-money's a good bet for that. I mean, the level of customization is probably more than some people want, but some people want like a simple plan that shows, what comes in, what goes out, add some tax, maybe some tax calculation in the back end. This is for our people that want to go into the details and truly understand what the impact is going to be of different strategies.
Yeah, Kyle kind of required it coming in this early stage. This is just our fourth year on with this business, so I see the monthly bill coming in, and we're paying for it. And I know you're using it, so it's
yeah, we're definitely getting what we pay for there.
Yeah, for sure.
It's a great software.
Yeah, nice.
And last slide with my last AI generated picture here on the right.
That's so AI.
Yeah.
That is so, Kyle, you've hit this out of the park until you put this never are you going to see you and I in a blazer and a button down shirt like that. But okay.
Yeah, I like the look, but yeah, it's a lot. And AI's that image was made in like 20 seconds. It's amazing.
All right.
But yeah, a couple steps. Just if this interests you to get started, here's what I would do first. Um, find an estate attorney that's qualified in your state, as the state laws vary between states. And then here's a few action steps. And what I want to emphasize here is that, having a financial advisor that understands your asset picture, your priorities. We're consider ourselves a resource to work with you through all of these 5 steps as you're working with your estate attorney, as you're consulting your CPA as needed. We want to, help just from the very first step, help you evaluate, who you're hiring, what they want to charge you, what they want to like. You're going to give them your information, at least high level. What are they proposing to you? Are they proposing a complex estate plan when you just don't need that? Or are they going too simple and maybe you have some needs that they don't understand? We can help you, vet and make the right choice from the very beginning. When you go through that process with the estate attorney, they're going to send you the documents, the trust, the will, everything. We're happy to read through, and we do read through those and make sure we understand what the plan is, make sure it makes sense. And then once you sign it, once it's in place, we help you implement it. So there may be assets that we manage that need to be retitled or reorganized or have beneficiaries updated. That's something that, the more we know about what your estate plan is, we can help you implement that and make sure that it's fully adopted. So that's kind of where we come in as the advisor. We want to be kind of the on one hand, like the coordinator, making sure everything is in process. And then on the other hand, we want to help you analyze, make sure you're doing the right thing. So that's kind of how to sum up the value we would provide through that process.
Well said. Well done, man. Hit it out of the park. I asked you to get into trusts and holy bananas, man. That was a masterclass. A lot there. Questions. Yeah, that was well done. All right. Well, InsideEdgeCapital.com, active portfolio management combined with comprehensive, obviously, financial planning is the key. Clients reach out if we need to update anything on your end. Prospective clients, go ahead and schedule a call. We'll get to know you. And other than that, we're going to have the live stream set up shortly. I will continue to chip away on that, but we'll leave it there. Kyle, great job. I'm going to run to the dentist. Any closing thoughts before we sign off?
No, we'll see you guys next week. Thanks for listening in.
Awesome. See you guys soon. Thanks.
See ya.